All right, welcome to part two. We're gonna go deep on some more data sets here. Now let's look at some other numbers that I wanna show you. So let's see here. Okay, so this next data set I wanna show you is our month supply of homes. Balanced market in Phoenix is about 4.5 months worth of inventory. What that means is in 4.5 months, all the buyers will absorb all of the homes that are out there with no new listings come on. The current buyer pool will get rid of it in 4.5 months. We're now at 5.1. I haven't seen 5.1 in a long time. And again, I've been doing this 20 years. A year ago, we were at 4.2, still below our average. 2 years ago, we were at 3.9. We're now starting to exceed those averages of supply of homes. And so what that's going to show up, well, how we're going to see that show up is in what I call the contract ratio. Contract ratio in a balanced market is between 30 and 60. 30 on the low end, 60 on the high end. Above 60, crazy seller's market, multiple offers, appraisal waivers, things like that. Below 30, we're starting to cool off. Well, it was 28.5 a month ago, and I think it was 29 2 days ago. Now we're already back to 31. And we get that by looking at how many actives we have on the market, 21,000, and then how many pending do we have at 3986. So the further those numbers are apart, the worse the number. So if you go back 2 years ago, you had 16,000 actives, 4,600 pending, and our contract ratio was 67. It was, 43, looking at supply index. So 43 is pretty much in the dead center. It's a pretty balanced market. Well, now instead of 16,000 active, you got 21,602 active and only 3,900 pending, right? So actives grew, pending shrunk. That's why that number is now closer to 30. So watch that number. That's the number I watch to see our pendings going down. And we do this year over year. So I don't, it's not fair to compare April to January. So we're looking January to January. 4,400 pending a year ago, 4,600 pending 2 years ago, 3986. So there's less buyer activity, which is causing the demand to go up and more people, or the supply to go up, and more people are putting their homes on the market. So here's where you can see that 84 supply, 76 demand. A month ago, we were 87 on the supply. So we've come down and the demand has shrunk a little bit. That's where the contract has improved a little bit. The market index is something I also look at, and that also shows the health of the market with actives and pendings. And what we're looking at is a balanced market is between 90 and 110. So 100 is like a perfectly balanced market, but we'll call it balanced even if it gets to 90, even if it gets to 110. And below 90, we're definitely into a buyer's market. Well, last buyer's market lasted for 2 months. This may have only lasted for a month. We're at 88.5. We've already dipped up to 90. So we'll watch that. A year ago, we were 116. So we were definitely a seller's market above that 110. 111 2 years ago. Now, prices is always the last thing to show up. And this, I think, is what frustrates buyers. When you look at price corrections, the sequence that we see, and having been part of 1,500 home sales, I can attest to this, but what we can document is the first thing that happens is repairs. So take a scorching hot seller's market. It's like no repairs. If it doesn't appraise, you pay the difference and waive your earnest deposit, right? Like those are those are the ingredients of a hot seller's market. As we get into a buyer's market, the first thing we'll see is, okay, we'll do repairs. So that doesn't show up on Zillow or the closings. You can't look at the net, you can't look at your neighbor's price on Zillow and go, oh, what they paid in repairs. So repairs go way up. We go from no repairs to we'll do them all. Second thing that shows up are closing costs. Hey, we'll give you $10,000 to buy down your interest rate. We'll give you money to pay your closing costs. Neither of those two show up on Zillow. So you could be waiting for a buyer's market by watching price. And in the last one, prices only dipped for 2 months. So by the time the prices dipped, it was gone. And I can tell you of some of my last few buyers, just my last 2 buyers came in. One came in 60 grand. So the appraisal was 720. They closed at 649. 60,000 below appraisal, and they got all the repairs paid and they got closing costs paid. The other buyer had 4% in closing costs, all the repairs done, and came in below appraisal as well. So we hit them hard on price, but we got all of our other terms. So those are the things that some people don't know they could get because they're just looking at price. Price is usually the last thing to show up, and it lasts it's the quickest, right? Price is coming down. That is the shortest lived part of a buyer's market. So you want to start with closing costs, repairs. That tells you the health of it. But when I see this 61.7, I would now expect to see some prices dip. But again, go back 2 years ago. This was January of 23, and we were in the midst of our buyer's market. We bottomed out December of 23. So 12 months later, we're going to bottom out. I'm going to switch screens. I'm going to go over to the Case-Shiller Index. So if you want to see this site, this is a really good site to see where Phoenix is. They only track 20 cities, and it is one of the most reliable ways to look at pricing. So if you don't want to trust your realtor, go to S&P, type in Case-Shiller Index, S&P 500 for Phoenix, and their methodology is awesome. Robert Shiller's an economist, I think out of Yale, but they know how to track housing. And so here, when interest rates spiked in May, June of 22, interest rates what's up? And so always remember this, real estate is like a seesaw. Interest rate, house prices. Interest rate, house prices. So when people are like, I'm waiting for house prices to come down, well, we're going to need to see a spike in interest rates. That's usually the biggest indicator. But if we start seeing the rates come down, expect prices to go up. So which is it? Do you want low price, high rates, or low rates, high price? That's usually what you have to trade for. So when those interest rates went up, you'll see we did a decline. It was about 12%. And we bottomed in that January, February of 23. So I said December 23, excuse me. I meant May of 22 to January of 23, December of 23. That's how short that market was for pricing to come down. And then we quickly went back up. So if you go back to the Cromford report, this bottoming of the market, we were sitting around that 59.7, but then eventually houses started to go up. So in the final part of this series, we're going to discuss which cities in Arizona are buyers markets and which cities are in sellers market. I think you're going to find this very surprising what a vast difference we have between our worst market for sellers or our greatest buyers market and our sellers market. It's like two different cities. So stay tuned, and I think you're going to find this very valuable. Dave Z, eXp Realty.